Hershey stock was my biggest buy in November. In this episode, we're going to explain why. We're going to take a look at their income statement, look at their balance sheet. We're going to run through how they've performed versus some of their competitors in the industry. We'll look at their dividend safety as well as some very important financial metrics. We'll peek at what the institutions are doing if they are buying or selling this company, and we'll see how well their earnings have been over the last few quarters. And as always, we'll run them through the valuation model, getting to our intrinsic value and our acceptable buy price. I'll discuss my strategy, what prices I have been adding, and we'll look at what Wall Street believe this company to be worth over the next 12 months. Now, year to date, they haven't had the best time. They've down 18%. A lot of this due to the macroeconomic conditions as well as the rising prices of cocoa, which is one of the main ingredients in Hershey products. They are pretty much there at the 52-week low. They do offer a nice starting yield of 2.57%, and we will discuss how that compares to their 5-year average. Now, they are up around 96% if you have been holding this over the last 10 years, excluding dividends, and we can see they did hit their peak in May of this year around $275, so they've fallen by nearly a third currently of their all-time high. Now, in terms of their income statement, remember on the top line we aim for 3 to 7% as a minimum. 7.8 billion reported in December 2018. Now, December 22, 10.5 billion, so some nice growth over the last 5 years. And looking at the trailing 12 months, it does look likely that they will be increasing their top line from last year. So that is positive, and do subscribe and hit the bell button so you are notified when we do drop a release on Hershey's latest annual report for 2023. On a more granular level, we do see increases every single year to their top line, which is a very positive sign and expected in 23. And when we compare that to their bottom line, the story that we can see here, 1.2 billion of net income in 2018, 1.6.5 billion in 22, and again we can see that trailing 12 months showing signs that this will have increased in 23 as well. When we look on a more granular level, we do see it does fall from 18 to 19 before picking up every single year. So strong income statement, both top line and bottom line is increasing. Now, quick health check on the balance sheet, total cash versus total debt, 588 million on the cash and balance sheet. Latest quarterly report, this has dropped very slightly to 471 million. And when we compare that numerically and directionally to their total debt, what we see in fact, 4.4 billion in 2018, 5.2 billion. So it has increased slightly over the last 5 years, but we can see in actual fact they don't hold that much debt on their balance sheet. Now, how has their performance compared against some well-known competitors in the consumer staples? We have General Mills, we have Danone, Kraft Heinz Company, as well as a few others. Now, year to date, we can see they are down 16.5%, including those dividends reinvested. One of the middle performing in the industry. We can see as a whole, this industry hasn't had the greatest year. When we compare that to the last 5 years, well, they are one of the best performing, just under General Mills GIS at a 92% return. So very positive to see. That is a big bonus. But as always, remember, we don't look at past performance as an indicator for the future. Institutional ownership, well, it sits at 56.5%, around 3 billion worth of sales by the institutions over the last 12 months. But over the same period, a lot more buying, nearly double in fact, by these big institutions. Q3, however, do note there was more selling than buying, depicted by the red total outflows, green total inflows. And if we go back the last 3 quarters, we do in actual fact see a lot more buying than the institutions than selling. But please do bear in mind that we don't copy what institutions do. Always do your own due diligence. Very quickly, let's look at the last 4 quarterly earnings. Well, there was a double beat in Q3 of 23. There was only a beat to the earnings per share in Q2. They did come slightly under in terms of revenue by 100 million in Q2. Q1 of 23, they had another very nice double beat. And Q4 of 22, well, they beat again. So this is a company that does consistently pretty much beat on their earnings. But that is just a comparison to Wall Street analysts. In terms of year-on-year data, well, Q3 23 versus Q3 22. They beat on the top line revenue, they beat on the bottom line, as well as earnings per share and some other metrics. So they are increasing both top line and bottom line year on year, which is a very positive sign to see for any company you look to invest in. Now, in terms of dividend safety, well, we see a score of 93. It is very safe. Market cap 38 billion. It is a large cap company. Now, in terms of some recessionary metrics, while they maintained the dividend during the 07-09 crash, now they had pretty much flat sales during this period, but remember it is above the average growth of companies, which was negative to a much larger degree, and they also outperformed the S&P with a negative 30% return versus the S&P's 55. Now, dividend growth is very important on this channel. Well, how about a double-digit increase this year at 15%? 9% on average over the last 5 years, and double-digit 10% on average over the last 20 years. Very, very strong to see. And they have been paying increasing dividends over the last 13 years. So a lot to love so far. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average, and this is a very strong yield right now at 2.5 versus their 5-year average, so we have our first sign of undervaluation. Keep in mind though, we don't look at any of these models in isolation and draw our conclusions towards the end. Forward PE 18.7 versus 5-year average of 24.3, another sign of undervaluation, and we can see their PE is pretty much in line with the sector PE at 18.4. Now, yes, it is trading right at the 52-week low, but as always, 52-week low is never a signal for undervaluation. Now, free cash flow payout, what we can see here, below 60% is my personal preference. You can extend it to 70% for consumer staples. And for those that are new, we do ignore the earnings. It is susceptible to manipulation by management through accounting. So, pretty good to see. It has been pretty much below 60% over the last 10 years for the large part. 44% over the last 2 years, but do note 2023 it is expected to increase slightly upwards to 54%. Free cash flow per share, very nice to see, more than doubled over the last 10 years, 375 to 880. It is expected to come down slightly in 23, but then expected to rebound up in 24. It is fairly inconsistent, but it is moving regardless in the right direction over the long term. Sales growth, personally, I like to see 3 to 7%. What we can see, it has been fairly mixed. Some years where we do see between 3 to 7%. Some years where we see flat growth or just around 1%. Last 2 years have been very good, double digit, as well as 2023 expected to be another double digit increase year. Numerically, for those that like to see the numbers, 7 billion in 2013, 10 billion in 22, 11 expected in 23. And on top of that, they also return excess cash to shareholder pockets by doing share buybacks. As we see over the last 10 years, they have bought back around 20 million shares. ROIC, very common for companies I personally invest in, 10% or more. It gives me faith that management are able to effectively allocate their capital, and it has been above that consistently over the last 10 years. Very positive to see, with the last 5 years being around the mid-20s. Operating margin, free cash flow margin, it is one, interestingly, where the consumer staple industry do tend to struggle, but Hershey's don't seem to be in that category, in around the low 20s over the more recent times, 23% expected in 2023, and the same could be said for the free cash flow margin. Very nice to see, consistently above that 7% minimum we look for. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, showing us two things, the dividend safety as well as the balance sheet strength. This essentially means we want it below 4, being the number of years it would take the company to pay off all of their debt net of cash on hand. 2022 sitting at 1.64, 2023 expected to be even lower. So this is a very strong company in terms of their balance sheet health as well as their dividend safety score. Now we can jump into the valuation. As always, if you enjoy the content, values being provided, do smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you want to click on the pinned comment below to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. Now, typically we use 3 models. The first one, 4 models. The first one is Graham's valuation, but for companies that do effectively have fast growing top lines, double digits, as we see with Hershey over the more recent periods, we do tend to skip Graham's model. But for those that are interested and want to know how it works, we have this stock ticker symbol, earnings per share, growth rate per analyst estimates, and then that current yield on AAA corporate bonds, which would give us the intrinsic value. So the first model we're using today is essentially the multiples valuation model, where we have companies in a similar sector and size that we ran through on the 5-year. Mondelez, Tootsie Roll, General Mills, Danone, with their PE multiples, we get the average multiplied by the earnings per share to get a multiples valuation price of 218. Now, when we take a look at the current trading price, that is some nice upside to the current value, but is within that 52-week range, showing some signs now of undervaluation. But do bear in mind, we don't look at any of these models in isolation, and we will draw our conclusions towards the end. So the DDM model, we have the yearly dividends year on year, growth rate on average around 10.5%, very nice to see, especially those triple digit increases over the more recent period. Forward looking, I've gone for 6%. Again, if you grab a copy of the model below, you can play around with the numbers based on what you believe. 252 is coming to our valuation model, again below the 52-week high, but still showing some nice upside to the current value that we see for the Hershey company. Now we move on to the third and final model where we have the DCF, the free cash flow year on year. Average growth at 14.5%, forward looking, analysts estimating between 10 to 12%. With our discount rate, we get the present value of these future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $262. When we compare that again to the current value, it is still slightly below the 52-week high, but again for the third time showing some strong undervaluation to the current market value. So the intrinsic value is pretty much the average of these three models that we've used for today's episode. And as always, if you enjoy the content, values being provided, do go ahead, smash that like button, hit the subscribe button and bell so you are continually notified of these videos as they drop. Margin of safety that we typically start off with, 10% if we believe to have a wide moat, strong financial metrics, good forward-looking data. Now, with the macroeconomic conditions, the high interest rates, and with the cocoa prices essentially rising, which will affect Hershey, some could argue that it's already baked into the price, and that is why the central share price has dropped by a third. Now, if you want a 15% margin of safety, you would be looking at 207, so it is still a buy. At 20% around 195, and at 25% margin of safety around 183, which is pretty much bang on at that 52-week low. Now, personally, I do quite like a 20 to 25% margin of safety for the Hershey company. There is a lot to love. We ran through the metrics, we looked at the company, their balance sheet. It is very strong, it is very healthy. They also yield when we looked at versus the 5-year average, and the PE shows signs of a lot of strength as well as undervaluation, especially compared to our intrinsic value. So this is one that not only I have been buying, but as it is around the $185, $186, it is one that I will continue to buy and add to the portfolio. Now, in terms of what Wall Street say, well, they believe the share price to go up as well, slightly lower than our intrinsic value at 244, but they do see a ton of upside, so they do believe it to be a strong buy. As always, let me know your thoughts in the comments below. Do you agree with what I've said? Do you believe that Hershey is at an undervalued price, or is this one that does really put you off just because it is at such a low yield? As always, if you enjoy the content, do smash that like button, do hit the subscribe and bell button so you are continually notified of these videos as they drop, and do click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list. As always, have a great day and catch you all on the next one. Take care.